Hey friends, welcome to FX Yogi. In today's video, let's get to know the GBP. The GBP must be a pretty popular kid since it has a lot of cool nicknames. Aside from being called the sterling and the pound, GBP pairs have awesome nicknames such as cable, that is GBP USD pair, and guppy, that is GBP JPY pair. It likes to bust more. GBP USD is one of the most liquid currency pairs in the Forex market. How come? Remember, London has long been a major financial center in the world. With major business transactions taking place every day, lot of moolah goes in and out of London. Still, the GBP USD only accounts for 14% of daily global trades, making it just the third most active pair traded. This is probably the reason why spreads on the GBP USD tend to be a pip or two more than that of the Euro USD and the USD JPY pairs. Traders like it because it's got some nice curves. With so many big time corporations being based in London, there are many highly attractive investments to be found in the UK market. Couple this with having some of the higher interest rates. Amongst the major currencies, investors may find British securities to be more attractive. In order to get their hands on these assets, investors would first need to purchase some GBP. It's nimble during the London session. GBP USD trading volume is the highest during the European session, with potential for strong moves during the New York session when key UK and US data is released. The Asian session does not normally provide much movement as European traders are still in bed while US traders have just finished their day. It can be kind of rowdy. The GBP pairs are very prone to volatile moves because of their low level of liquidity compared to that of the euro. With liquidity growing thin at certain times in the market, the GBP can get caught in one direction, especially if there are large buy or sell orders in that direction. Compared to other currency pairs, GBP pairs tend to react more strongly to surprise economic data releases. Now let's have a look at the important economic indicators for the GBP. Consumer Price Index CPI. The BOE looks at this account as a measure of inflation. It measures the change in the prices of consumer goods. Unemployment rate. This is the measure of how many unemployed people there are in the UK economy. Analysts look at this account carefully because it could be a leading indicator of future spending. How come? Well, if a person has no job, he has no money. Without any money, nobody would be able to afford tea time. Gross Domestic Product (GDP). This figure reflects the state of the UK economy. It indicates whether the economy is growing and booming or if it is stuck in the English Channel and drowning. Purchasing Managers Index PMI. This index surveys business managers and asks them their view of the current economic landscape. Scores above 50.0 indicate improving conditions, which may lead to expansion, while scores below 50.0 hint at possible contraction. GfK Consumer Confidence Report. This report gauges consumers' confidence about current and future economic conditions. The more confident consumers are regarding the state of the UK economy, the more likely that they will be willing to spend. That's all for today. Let's catch up in another video with more interesting content. Until then, take care. Bye bye.